A DIFC Variable Capital Company or VCC is designed to hold investments with flexible capital and, where required, segregated cells for different assets or strategies. It is a private company under the DIFC framework, but it is not automatically regulated as investment fund or goes under the DFSA authorized fund manager requirement, provided it does not carry on regulated financial services. My name is Shiraz Wahid and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how to set up a DIFC VCC step by step, how to choose between a standalone company and a cellular structure, what document and governance requirements are, and what to organize after the incorporation. But before starting with the incorporation application, we need to decide what VCC will own and how the control will operate. Now for this, the first step is to prepare a clear structural plan. A standard VCC will generally be licensed as a holding company so that the application should explain the assets it will hold, where they are located, who will fund the company, and how each shareholder will participate. For a family, the VCC could hold investment portfolios, shares in operating companies, private equity in trust, or other permitted assets. It can also sit under a foundation, trust, or a family holding structure where the wider arrangement is legal and tax appropriate. You should confirm that the proposed activity remains proprietary. If the VCC will manage money for third parties, promote investments publicly, provide investment advice, or conduct another regulated financial services, the DFSA or the Dubai Financial Services Authority position must be reviewed before incorporation. The company's legal form itself does not remove financial services regulation. You should map the ownership chain from the ultimate beneficial owner down to the VCC and its assets. This helps identify the source of wealth evidence, the tax residency of each relevant person, and any approvals needed elsewhere. The next decision is whether to use a standalone VCC or an umbrella VCC with cells. A standalone structure is usually suitable where the assets follow one investment strategy, have the same ownership, and share the same governance. An umbrella VCC can use either segregated cells or incorporate cells, but it cannot combine both types. A segregated cell forms part of the same legal person as the VCC, while its assets and liabilities are allocated separately. An incorporated cell is a separate legal entity within the VCC framework with its own assets and liabilities. The choice affects the contracts, banking, accounting, administration, and the cost. Segregated cells may provide more centralized arrangements, while incorporated cell can offer clearer legal separation for assets requiring separate contracts, financing, or ownership. One cell may hold a liquid portfolio, another can hold private company shares, and a third cell can hold separate family assets. The accounts, contracts, and day-to-day conduct must preserve the separation. Cellular protection depends on correct administration and should not replace legal advice. A DIFC VCC must meet the eligibility requirements in the regulations. Eligibility can arise through the people controlling it, the assets it will hold, an approved qualifying purpose, or structure supported by an eligible corporate service provider. Most private applicants will need to appoint a DFSA licensed corporate service provider or CSP. The CSP supports incorporation, the registered office, compliance filing, and connecting with the DIFC registrar. Certain VCCs controlled by qualifying DIFC entities, authorized firms, government entities, or recognized listed companies may be exempt. The VCC must have at least one shareholder and one director. The application also requires an authorized signatory and a senior management representative, while a company secretary is optional. Governance should also still be designed properly where one person fills more than one permitted role. Decide who can approve investments, open accounts, sign contracts, issue or redeem shares, and transfer assets. These parts should align across the articles, the board resolutions, signatory arrangements, and family governance documents. Once the structure is agreed, we prepare the application to be submitted to the DIFC. For individual shareholders and directors, expect passport documents, verifications, and professional background information. For corporate shareholders, it is normally expected to provide incorporation documents, ownership records, and board resolutions. Where a trust appears in the ownership or control chain, the relevant trust documents may be requested. The application must explain source of wealth and source of funds. Where a third party provides funding, supporting bank statements or financial statements or investment agreements may be required. You must also identify the ultimate beneficial owners and explain any person exercising significant control. The company name must end with VCC Limited or VCC Ltd and should reflect its holding activity. You must decide the share classes, number of issued shares, and allocation between the shareholders. A VCC does not need a nominal value for its shares. Its capital is linked to the net asset value, and the article should address the valuation, share issues, redemption, repurchases, and distributions. Now, once the application is submitted to the DIFC, there is no payment that is required at the first stage of submission from the DIFC. The DIFC then carries out its initial review. Official guidance indicates that initial approval is normally issued within 3 to 5 working days, although the complete process may take longer if ownership checks and documents require clarification. After the initial approval, the constitutional documents are issued by DIFC for electronic signatures. The applicant pays the registration fee, license and data protection fee, and then DIFC issues the commercial license and certificate of incorporation. The official VCC incorporation fee must be cleared before the incorporation has been completed. Additional costs may include the CSP, registered office address, legal drafting, accounting, tax advice, banking, and anything related to incorporated and segregated cells. A segregated cell has its own separate formation fee, while incorporated cell has its own incorporation and annual license costs. The budget should follow the complete design rather than parent VCC alone. Where the VCC will operate as an umbrella, cells are formed using the relevant DIFC process. Each cell needs a separate name, defined shareholders or economic interest, its own share allocation, and a clear description of assets and fundings attached to it. The contracts should identify the correct cell every time. Bank and custody accounts should be opened in the correct name, and agreements and board records should show which part of the structure is responsible. Funding for the VCC should start only after the ownership, valuation, and tax treatment have been reviewed. Transferring an existing portfolio, company shares, or property-related interest can trigger consent requirements, transfer taxes, reporting obligations, or gains in other country. Domicile, personal residency, corporate residency, and the location of the assets all matter. A DIFC company does not by itself remove tax or reporting obligations connected to the family, shareholders, or investments. After incorporation, the VCC needs working infrastructure. This normally includes bank or custody accounts, accounting records, valuation procedures, board processes, and investment approval policy, as well as a calendar for regulatory and tax filings. A VCC cannot employ staff directly, so administration and professional support must be arranged through appropriate service relationships. It must maintain proper accounts, and a cellular VCC must keep each cell's assets and liabilities clearly identifiable. The annual license and confirmation statement must be renewed on time. Changes to directors, shareholders, beneficial owners, and registered office or share capital or articles generally need prompt filing, commonly within 30 days. Annual accounts must also be prepared and filed within the applicable timeline. Tax registration and treatment should be reviewed separately. The UAE corporate tax, the free zone rules, the participation exemption, VAT tax, and international reporting all depends on the VCC's income, activity, ownership, and substance. The analysis should also cover shareholders and every jurisdiction where assets are held. Finally, test the structure against real decisions. Confirm who can sell an asset, admit a shareholder, redeem shares, create a cell, approve distribution, or respond if director becomes unavailable. The legal design and the family governance all should follow the same control model. So if you want our help and would like to explore whether this structure of VCC or international foundation or trust can suit your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.